Revealing my 1 million portfolio. The easiest way to become a millionaire in Singapore is to start as a billionaire and make the wrong investments. Ha 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 ha. Joking only, you. Don't be so serious. If you are watching this, hello there to you, and welcome to What is the Matter, where we talk about money matters. Today I will be sharing with you my 1 million portfolio. Before you say I am a Hao Lian person, according to statistics, there are more than 300,000 millionaires in Singapore, and some of them are multimillionaires who live like a king. Definitely. Confirm and triple confirm, I am not one of those. Unfortunately, some millionaires don't believe in investing, or they don't know how to invest. Wasted lie, I feel. In 2022, the US Federal Reserve is hiking interest rates to curb with inflation. Interest went high and higher up into the moon. At that point of time, fixed deposits were giving crazy interest rates. In Singapore, our monies with the bank are protected for up to $75,000 per bank. That's why we refer to fixed deposits as risk-free rate. Imagine you do not have to take a risk, and you get a decent 4% to 5% per year on your amount. Would you want to invest in the stock market at that point of time, where it is so volatile that it looks almost like my ECG graph? Ha 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 ha. It's like up and down every single day. Without doubt, people would choose to go for risk-free instruments, and I am one of those. In my first deployment of my funds, I deployed a sum of $320,000 in total to Maybank. I chose Maybank because it was giving one of the highest interest rates in town at that point of time. For my first $200,000, which I put in the fixed deposit, I managed to get paid 3.8% per year for 2 years lock-in period. At that point of time, Maybank also paid me upfront, which means that they pay the interests before your lock-in period. Of course, if you withdraw your funds earlier, they take the interest back from you. For my first $200,000 with bank, I am paid a sum of 3.8% multiply 2 years, multiply 200,000, and that adds up to $15,200. Not bad, right? During my next fixed deposit, however, the interest rate dropped slightly. There were also talks about Federal Reserve may stop hiking interest rates soon at that point of time. For my next $120,000, I was only paid 3.5%, and I have locked in for 1 year. That will equate to $120,000 multiplied by 3.5%, and I receive an interest of $4,200. In total, I have received an upfront interest payment of nearing $20,000 virtually risk-free. Next, I have invested about $500,000 in corporate bonds. For those who are not sure what corporate bonds are, a corporate bond is a debt security issued by a company to raise capital. When you buy a corporate bond, you are essentially lending money to the company that issued the bond. In return, the company pays you period interests known as coupon. Let me show you the 2 corporate bonds I have purchased. The first reason I bought into this bond was because I like good names. The issuer of the bond is important to me. Although bonds are typically safer investments than equities, there are issuers which can go bust. For my first bond, the issuer is Singapore Technologies Telemedia Private Limited. They are in the business of specializing in communications and media, data centers, and infrastructure technology businesses globally. Most important to me, they have a strong backing. The bond pays me a coupon rate of 4.1 per annum. As you can see, the minimum investment quantity of a corporate bond is $250,000. This means that I will get a coupon payment of 4.1% multiply $250,000 every year, which equates to $10,250. I will get this amount every year, so long as the bond is not called back by the issuer. According to the fact sheet, this is a perpetual bond, and this means that this bond has no maturity date. The issuer have the choice to keep on paying you 4.1% interest rate every year perpetually. But note that they also have a choice to call back, which means that if they wish to pay you back your amount of $250,000 and stop the payment, they can choose to do so on 2nd July 2027 and every 7 years thereafter. I will stop the explanation for now and explain more in my future videos on corporate bonds. The second bond I deployed my funds into was into Sing Life Aviva. You would have understood now that this bond pays me a coupon rate of 3.375%. This means that for a sum of 250,000 Singapore dollars, I will receive $8,437.50 every year. The difference is that this is a dated bond. You can see that there is a maturity date. This means that if I don't sell away my corporate bond, I will continue to get $8,437.50 every year until the 24th of February 2031, when the issuer will return me back my principal amount of $250,000, and I get to keep all the coupon payouts received. To illustrate this, I bought this bond in the year of 2023. Assuming I hold the bond until 2031, that will mean a total of 8 years. In total, I will receive $8,437.50 per year, multiplied by 8 years, and that equates to $67,500. You may be wondering, if the first bond pays me 4.1% and the second bond only pays me 3.375, why did I choose to buy the second one with a lower coupon rate? The answer to this is... This is my secret. Wait, I am joking only la. The real answer to this is, I have a different strategy used for this bond. I intend to trade. If you noticed, bond prices are sensitive to interest rates. The higher the interest rates, the lower the bond price. And if interest rates decrease, bond prices increase. They have an inverse relationship. I know that Federal Reserve of the United States cannot be hiking interest rates perpetually. It has to come down one day, either because inflation has somewhat eased, or if the economy falls into a recession and they do not wish to further detriment the economy. With this reasoning, I bought into this bond. Once the Federal Reserve lowers interest rates, I have the confidence that the bond price will increase. At that point of time, I may choose to sell away the bond for a profit. Again, in order not to confuse the less financially savvy, I will stop my reasoning here. To find out more about bonds, you may look into my future videos. For the rest of the 1 million, I invested into exchange-traded funds. Boring you may think, but to me, these are good ways to increase my wealth. I also do a simple trading strategy to boost my returns. With the strategy, even if, for example, the S&P 500 yields a positive return of 10% for that year, my return could be 15% to 17%. These are what I do for my investments, and these are for sharing purposes only. This is what I have done for myself, and is never a recommendation made to anyone. Okay? In my future videos, I will be sharing with you on how I use a simple trading strategy to boost my returns for ETFs. I will also share more information on the types of corporate bonds and how to read the bond fact sheets. If you are concerned about Mr. What is the matter, and you want to kaipo on how Mr. What is the matter does his investments, subscribe to my channel to Huat